sovereign debt crisis as well. Remember that it wasn't all that long ago that we had the pigs of Portugal, Greece, Italy, Spain, Iceland, that nation of 300,000 cod fishermen turned investment bankers who geared their country to financial ruin. And we had the world feeling it was perched on top of a major debt bomb. And the fuses had been lit, and we were just sort of waiting for them to go off. But they didn't. And we had Brexit, and we were waiting for the world to end, and it didn't. And we had Trump, and well, the world almost ended with Trump. But I suppose when your head general is an organic food only QAnon shaman named Jacob, well, I think maybe we had a little less to worry about in hindsight with that. And we've had Zupta. Let's not go there. We've had COVID. We've now got level 3 with its specific characteristics, shall we call them. We've got load shedding level 3. So I guess that means we're in level 6. Deep in the economic excrement, but it's just an example of the bewildering time that we're living in. But you know what? This is when true entrepreneurs and management teams shine. Apart from all of the crisis that we've seen over the last 5 to 10 years, small and mid caps are roaring back here in South Africa. Management teams have delivered in the toughest of circumstances, and it really has been remarkable to witness. Businesses that have had their business models literally obliterated, like Quicket. And I'm sorry to pick on one of your portfolio companies, Kit, but what do you do when your business is selling tickets to live events and the whole world says, sorry, you probably won't have any more than 50 people in a room or even outdoors until we all get vaccinated? Well, you know what? Quicket changed its business model and was profitable again in October, just a few months after lockdown began. And the reason I mention this is because despite what the world throws at us, the politics and the pandemics, the best jockeys just tuck their elbows in and they get a little closer to the horse and they ride on, and they ride with even more determination. And it's just in the nature of the beast. Now, I've been editing a private equity magazine for the better part of 15 years now. I've interviewed hundreds of entrepreneurs, and these men and women, along with the doctors during the COVID crisis, we must add that, are the true heroes right now. And we celebrate them, and we hope that government starts to realize it should be doing everything in its power to make South Africa the preferred destination to build, grow, and exit great businesses, as we're looking for a way to chart a course out of this pandemic-induced, and I must add, own goal abetted economic crisis. And from what I've seen with Section 12J, when one removes the outliers, and there are some outliers who sail against the spirit of this legislation, what I see with Section 12J is an incentive that works to achieve exactly that outcome, to make South Africa a preferred destination to build, grow, and exit great businesses. So this evening, we're going to share some of those incredible stories with you. And I hope, and I really do hope, that the Finance Minister is listening, not just to the industry, but to the men and women who build businesses with these Section 12J equity partners when they implore him to keep the incentive going. Because as COVID-19 causes our fiscal deficit to bulge even further, perhaps a little less than anticipated, thanks to the better than expected tax take numbers, thanks to the mining companies, the big question is, what role should and could incentives like Section 12J play in supporting SMEs through the crisis? And Treasury itself has pointed out in its economic strategy document of a couple of years ago, creating an environment in which SMEs can thrive is inextricably linked to creating conditions in which all businesses can thrive. And one of the main challenges to the growth of SMEs is access to equity finance. And surely this is an incentive that has very neatly solved for that. Now, others might know them as men in shiny suits selling tax-free investments. As I said, they're not all the same. They're not all created equal. And I'm sure there isn't a shiny suit amongst our speakers for you this late afternoon, early evening. We've got the likes of Darren Folds. He's a fund manager at Meta Capital. He's going to be presenting the S12J Meta High Income Fund. We've got Gaurav Nair, who will present the Infinity Anchor Investment Opportunity. We've got Kip Darvel, who will present the Enreach One Investment Opportunities. We've got Renier de Wit. He's going to be presenting the Gaia S12J investment opportunity, big into the ESG space. Clive Butko will present Kalon Venture Partners 2 investment opportunity. And then Keert van Zyl is, we've saved the best for last. Keert's putting his hand up there, is going to present the S12J KNF2 Knife Capital investment opportunity. So lots to look forward to. And with that, I'd like to hand over to Anil Govind, who's Executive Director of Innovates Alternative Assets, just to give us an overview of the Section 12J landscape and some of the options that are available out there.
Hi, good evening, everybody, and thank you to all the panelists for joining this session. Really appreciate you guys making the time. So yeah, firstly, the weather is getting better, and I understand it's load shedding today, but thank you for all the participants that made the time today. Look forward to you guys enjoying this. Yeah. So let's look at. Just can everybody see the screen? Yeah. Okay. Sorry, 1 second. Right, so Innovate Alternative Assets, we've been operating from early 2018. I started in 2017. Basically, our main area is alternative assets. The reason why it came about is that, in the normal traditional space, only 6% of South Africans can retire, so there's a need for better returns, and we're quite vigilant in terms of due diligence and making sure that we're getting to projects or companies or private equity kind of companies that can deliver a return. So our 3 points that we live by: innovation, collaboration, and vigilance. And we also feel investors must be vigilant in terms of the performance of the investments. So yeah, we tax structuring specialists. We've been doing this 28 years as a CA. I've done this for most of my life in Durban, ex-KPMG. My partner is ex-EY. So we come from a typical financial tax background. And we do that. 30% of our business is tax structuring. But our returns-wise, alternative assets are property, lending assets, basically private equity, business opportunities, etc. We're also very big in offshore. We have moderate risk and private equity opportunities in US and Europe. So today, that's it for the introduction of Innovate. So we move on to 12J. So 12J came about because of, the government felt it was a more efficient way of creating a job as compared to the banks and other mechanisms that the government has. And yeah, it was really to create a job and reduce unemployment. And the other side was to encourage entrepreneurship, right? So basically, by allowing a person to invest in a 12J company, it allows them to get funding, which may be difficult for the bank and other parties. So 12J is part of the Income Tax Act, and effectively, the incentive the investors get is that they get 100% tax deduction in the year of investment. So I just thought I'll put down very simply what the funds are in the 12J kind of industry for people that haven't been exposed to this. So in 2009 it started, and the rules were not so favorable. And in 2014 there was a lobby group that actually, motivated for example, unlimited, deductions, things like that. And they were successful, basically driven by some of the guys from GrowVest also. And you can see the growth from 2017, especially 2018 and 2019. 2019 alone was 5.1 billion, raised in 12J companies. And effectively, in 2020, the Treasury felt that, they were losing too much of revenue, and they imposed a maximum of 2.5 million for an individual or a trust. That's a maximum limit now. Obviously, a retirement annuity is only 350,000. So this is like effectively, 6 or 7 times its value. So 2.5 million for the individual trust and 5 million for a company. So, and if you have multiple companies, obviously it's 5 million per company. So Okay, thank you, Matt. Okay, great. So the tax deduction, you get 100% upfront tax deduction. It's claimed in the year that you do the investment. Provisional taxpayer, if he's paying provisional tax, the accountant has to estimate the tax. So if you provide for the 12J, it's same like a RA or retirement annuity, you can actually reduce your provisional tax. And for the employee, you would obviously had already paid the tax in terms of PAYE. So if you do a 12J, let's say 15th of February, the tax returns will be submitted after year end, which is around June, July, August. And the moment that is submitted, you claim the tax deduction, 100% tax deduction for the 12J. You get a 12J certificate. And based on that, obviously, you'll get a refund. So the PAYE person gets a refund of, if they're on the marginal tax rate over 1.5 million, 1.57 million, they're getting 45% back 7 months later. And obviously, a provisional taxpayer gets the benefit. If he does it on the 15th of February, he gets the benefit immediately, the reduction of provisional tax by end of February. I discussed the limits there. So one thing, there's a sunset clause, 30th of June, and effectively, we haven't heard from the Treasury stroke, SAWS. So maybe at the budget speech, they'll announce something, but if nothing is announced, you won't get the tax benefit post-June 2021. There is a 5-year lock-in period. Receiver doesn't allow you to invest and actually allow, they want people to invest long-term so that the jobs are created for that period. So the main difficulties faced by the markets, we've been in this game for 4 years now, been very strong. We do updated due diligence usually on a quarterly basis. Some of these 12Js have been with us for the last 3 years. And we find the main issues are deployment. Sometimes if a company is in the early days of its development, deployment takes a bit longer. And if it takes a bit longer, it won't affect the overall return over a long term, but over the 5-year period, if it takes 2.5 years to deploy, obviously the return does get affected. In terms of fees, we find that some of the industry have not been too good in the space. We like fees to be based on especially performance fees to be based on after the original value of the investor was repaid, not on the net investment, which we've seen at times. Exit is a very important thing. This is an unlisted space. It's not a listed space. And, if the 12J has made a proper plan to actually, provide for exit at the point of inception, of the point of investment into the company or the project or the qualifying company, and they've thought about 3 or 4 plans in terms of exit, I think that's definitely better because it's not so readily saleable. So some companies are better than others. And then sometimes you have to watch also if the returns are too low. And also, we're also pretty vigilant that, people do not hide behind the tax side. We look at the investment case independently, and we say, would you do the investment if you had no tax benefits? And if that's the case, we say, go ahead, yeah. Next step. So I'm going to shoot through this pretty quickly because of time. So normally the investor profile in the alternative asset space, and specifically we're dealing with the 12J space here. So on our side, when we look at a client, a high net worth client, we're looking at basically around 20% of the assets in total. And in the 12J, we find 5 to 10% of the investable assets in this kind of asset allocation can make sense. And obviously there's moderate risk and there's high risk. And so you choose your risk profile of the 12J based on the profile of the management viability and actually how they've been performing in the last period. So one thing, there is the potential of enhanced returns from this asset class that can lift your total portfolio. There should be appetite for some risk, but you do get moderate risk, moderate high risk, and high risk. High risk being more the technology stuff. I may feel that's not the case anymore because technology is the area that's running. Yeah, and I think you need to look at that all in total. Yeah. So that manager experience and track record, size of fund, the investment pipeline. That means are they able to deploy in a quick time frame? Because that is the important thing, as I discussed earlier, and then exit strategy. Matt. I've just done a simple slide here. If somebody is earning a taxable income of 3 million rand, if they did no 12J, effectively, they'll pay 1.1 million. That's net of, that's based on the table. Over 1.57 million, you'll be paying 45%. And in total, that will be the tax, 1.18 million. And if you did the 12J, you get an immediate deduction in the year of investment. So you did it 15th of February, which is next week. Immediately you get a deduction for end of February for provisional tax. And as I said, for PUI, you get a refund later when you submit the tax return. So now your taxable income, when you do the 12J, revises to 2 million rand rather than 3 million rand, which means that the tax payable is now 734,458. And effectively you're saving 450,000 because that's the marginal tax rate over 1.57 million, anything earned over that, right? So I regard that as B. And the tax return is adding power to this, power to the investment return in total, for sure. However, the second part is A, which is the return from the business. And we say a moderate risk profile should be giving you around 6 to 11%, and really more towards the 6 to 8% you'll find. And that's like asset rentals, asset rental businesses, fund of funds like Meta Capital. Moderate high risk is something like Gaia and Enreach, we regard as moderate high. That's why we provided 2 in each category. And there you're looking at 12 to 20%, more like 12 to 15 is moderate to moderate high in the private equity space. And then the high risk space like technology or anything that is in that kind of area, it's high risk and high return. So they're looking for a 30% IRR, so that is independent of the tax, and sometimes a lot of companies try to mix that up and actually investors are confused. We try to unbundle that. Yeah. Matthew? Okay, so summarize here very simply. If somebody has started, beside the tax benefit, this part I regard as very important, that if you had to pay the tax, so you start with 1 million rand, you pay 450,000 rand worth of tax, your investment only starts at 550,000. I don't know if you guys can see that. So effectively, if you had 8% return for a period of, I think that graph shows 7 years, there's a slight error there. So effectively, the value of that with 550,000 that you started post-tax goes right up to, 942,000 at the end of 7 years. Whereas if you started with 1 million rand, now you got 1 million rand, you got the 450,000 saving immediately at upfront. The 550,000 is already in that 1 million rand investment. So you're starting with 1 million rand. So it's effectively, you're starting pre-tax with the 12J deduction. Another one, you're starting post-tax. By starting at 1 million rand at the same return, which is 8%, which is not so high, a moderate risk type of opportunity. The difference is the other one grows to 942,000 after 7 years. And when you start at 1 million rand, you actually end up at 1.7 million. So just that alone makes a massive difference in terms of building wealth and creating, improvement and growth in your assets. So I really find that very powerful in terms of that. It's like actually in the tax world, if somebody had to fund their children's educations post-tax, they have to use that 55 rand to fund their education. Whereas if you do it in a trust, basically, especially if you have a family of 2 or 3 children, automatically you can fund it pre-tax because of the fact that a child gets also 80,000 rand tax-free per annum. So in the same way, 1 million rand is what you start with when you do 12J because you're not paying any tax on that million. So we base at the campus in Bryanston, Roland Garros building. And I just encourage you guys and also the panelists, if any queries come up, prefer if it comes via us. So we will direct it then to the individual 12J companies, which we are doing. Yeah, there's 7 companies we're doing, but these are the 6 that we are offering this year. So thank you guys. I wish you guys enjoyable rest of the evening. Yeah, thanks. Bye.
Super. Thanks, Anil. Powerful stuff. Great slides there. And if anyone can hear the fan on my laptop, it could probably power a small Eskom power station at the moment. I don't know what's happened. Too many webinars in the last year. It's starting to pack up on me. So I apologize if it's causing a bit of noisy feedback. And I would also just like to remind people to, rather than raise your hands, we've got 130 odd participants now. Just type in the Q&A or in the chat box, and we'll try and respond real time, rather than going through raising hands and unmuting and all of that. It's just a far more efficient way of communicating over the course of the next 2 hours. So with that, we've got our next speaker. Meta Capital launched the first ever portfolio of funds, a fund of funds approach. That was back in 2017, if memory serves me correctly. They did a swanky launch at Summer Place. And we're going to be joined now by Darren Folds, who's a Meta Capital fund manager, who's going to be presenting on the S12 J Meta High Income Fund opportunity. Darren?
Thank you, Michael, and thank you, Anil and Matt and the Innovate team for organizing another fantastic event, albeit this time not in person, obviously for obvious reasons, but excited to be here and excited to discuss with you our fourth portfolio funds offering. Michael hit the nail on the head. We were founded in 2017, and throughout that entire period, since really the start of 2015 onwards, we really came to the space at the heart of it's about to take off. We saw a huge need in the market for an independent aggregated product vehicle, much like what you would be invested into within your traditional RAs, your ETFs, your tax-free savings, etc., where you have a variety of underlying assets nicely compartmentalized within a product vehicle, and really allowing for the new wave of capital to make its way into 12J to allow a unique, affordable diversity opportunity for South African taxpayers to get diversified access across some of the most market-leading Section 12J entities. And so Anil touched on it in his opening slides, just the growth of 12J, not just obviously in participants, where there's close to 200 now, if you can believe it. Each will provide an investor with that Section 12J incentive, each of them approved by SARS, the MOIs vetted for the specific sectors and trades that are allowed within the space, but also in assets under management that these funds now hold. And that's as a result of South African taxpayers turning to this asset class, and we believe for three kind of distinct reasons. The first, obviously, is certainly getting 100% of your capital to work for you while you are downside protected by as much as 55%. And that's, and when Anil talked through to those slides, obviously that is a significant tax incentive. 12J was based off the VCT scheme in the UK, where they only provided UK taxpayers with a 30% tax break. So obviously SARS and Treasury really, you're trying to utilize this particular incentive to stimulate growth, stimulate access to finance for SMEs, and in line with that, job creation. So certainly the tax incentive has been a large reason why people have turned to the class. But importantly, specifically over the last few years, we've seen a real move to the asset class for its uncorrelation benefits. And in our biggest partner to date, which is Standard Bank Wealth and Investments, this has been identified as one of the key reasons to have this particular asset class in clients' portfolios. The uncorrelation benefits are really influenced because the asset class invests into macroeconomic climates and obviously are affected by those specific factors. So your specific trade wars and other macroeconomic factors don't impact the portfolio like they do with your other asset classes that you're currently invested into. So the uncorrelation benefits are extreme. And I think last year, specifically during COVID, we saw that demonstrated and actually pull through very strongly. And then thirdly, that certainly has a part to play in individuals' tax planning. If you look at the mitigation of CGT events, be it sale of a property, shares, bonuses, etc. We saw NASPA's process, the conversion last year, be a huge inflow of 12J capital.
I think Darren's just frozen for a second.
Split into pre-investment and post-investment. Pre-investment being that we conduct a strenuous investment process that compile and weight portfolio of 12Js for our investors and the South African taxpaying public at large, as well as our approved distributors. We then allow for a 350,000 Rand minimum where an individual can have access to, in this particular case, which I'll present, 5 different 12J vehicles in different sectors of the economy run by different fund managers, etc. Post-investment side, we have a very strong and market-leading quarterly reporting function where all of our investors can house and track their investments in one place, have quarterly look-through into the performance of each of the underlying funds, and have an overall view on the performance of the portfolio as a whole and the cash activity and dividends that's been paid out of that particular portfolio. Secondly, and I'll touch on to the board of directors in a moment, who really the gravitas behind the product, you have a strong team and investor liaison where you can, through a single liaison, liaise with the underlying funds within your portfolio. You have experienced board of directors that monitor the investor risk performance on a quarterly basis. And again, that gives comfort for investors, and specifically some of South Africa's largest wealth managers who manage high net worth individuals who are looking for that service offering. Our investor experience is really centered around personalization and also allowing you as the investor to house your different 12J investments in one place. It's specifically ideal for the first time Section 12J investor to have that first time experience in Section 12J through different sectors that's been hand selected by our investment committee. And to go into a little bit of who that team is and the gravitas behind the processes we run to select the portfolio, which I'll demonstrate to you in a couple of minutes. Adrian Saville is our independent investment committee chairperson. He's the current CEO of Cannon Asset Managers, recently acquired by Bidvest. Mark Teke is the chairman of our board and also sits as a member of our investment committee. He's the CEO of Sereti Resources, former president of the Chamber of Mines. Nick Dennis, the former CEO of Tiger Brands, and then Doug Smolin, the former chairman of the Smolin Group, probably the country's largest private company. And this really sits as the investment team that not only identify the funds that make up our portfolios, but are involved in the ongoing performance and monitoring of these particular portfolios we launch each year. In building the high income fund, and I'll touch on the reason as to why we've called it the high income fund, we go through a strenuous investment process. This, our fourth process, conducting a lot of due diligence within the space, building and compiling a portfolio that best meets our strict investment criteria. And the reason behind the high income fund in this particular year is that we've identified quite a gap in the market post the pandemic, where obviously interest rates are very low, yields in the listed and traditional asset classes are currently can't be found, and we found and identified an opportunity to create a portfolio that looks to yield an average annualized 8% in dividends for our investors over the 5-year investment term, plugging the gap that currently exists within yielding projects, and obviously putting that into a tax wrapper and incentive enhances the returns on a risk adjusted and a risk arbitrage basis. And I'm just going to touch into the composition of our portfolio and a little bit into the structural reforms of Meta Capital. You as an investor obtain physical share certificates and tax certificates in each of the underlying entities. So we ourselves aren't a traditional fund-of-fund structure, and that's why we don't have an additional layer of fees for our investors. So you can invest into the 5 underlying funds at an affordable diversity minimum of 350,000 and obtain that share and tax certificate in your own name. We have weighted and compiled the portfolio to optimize risk mitigation and returns. And just to touch on the 5 funds that we've included, Nessa Investment Holdings is a renewable energy fund within the corporate industrial space, close to 4 years of track record, almost 50 investments to date. One of the leaders we found not just in Section 12J renewables, but into the tire sector. Gaia, which you'll hear from Rainier, is a stalwart within our funds due to this fantastic track record, which we'll hear a little bit more about, but specifically like the sectors in the agricultural and infrastructure space and have a high allocation to that particular area this year. Sunstone, which is a movable asset specific investment strategy. Classes really exist within medical operating leasing equipment, allowing medical practitioners now to scale their operations at really strong yields for our investors, really liquid investment strategy. Then the central complements Nessa. We have a 40% allocation to renewable energy this year. In fact, 12J really presents investors with one of the most unique asset classes to get involved in. There is no real asset class that gives you direct renewable energy exposure like Section 12J. There's nothing within the listed space that allows you to access this particular asset class. And unfortunately for you and I, not only being Eskom and load shedding and being the best marketer for this asset class, but for you and I, there are double-digit increases on the way from NERSA. And what's good for investors in this particular space is those double-digit increases make themselves available in a way that the dividends that they receive are also escalated by similar amounts. So you have dividends that could escalate by double digits as a result of an allocation to renewable energy. So in a very exciting sector for us. And then Optimize is a mezzanine finance credit play. And when I speak about mezz finance, I'm really talking about a credit enhancement investment vehicle, much similar to a bond, where a credit enhancer or a guarantor provides a guaranteed yield for investors. That guaranteed yield makes its way, in this particular case, to close to a 5% dividend for our investors every year, as well as a guaranteed liquidity option at the end of 5 years, where our investors get a minimum of a 10% capital appreciation. So within the portfolio, those are the 5 entities. That's the sectoral diversity. Within it, the common theme is strong asset underpins that yield predictable returns, mostly on the back of contractual revenue, and they have a very strong pathway to liquidity, as in the assets can be realized to facilitate exits day 1 of year 6, fulfilling some of the key mandates Anil spoke about in investment decisions within 12J, being liquidity, being returns, being stability, etc. That's where the high income fund has been built on. There are fantastic plays within the Section 12J space on different risk profiles, different risk levels. We've highlighted a portfolio that looks to yield stable, predictable returns. And to show you what those are, just to look at a bit of an individual basis and to use R1 million as a round number, you can have a look at the dividend yield that looks to escalate in year 3, 4, and 5. The combination of different sectors allows for that gradual escalation throughout the investment term, as well as the capital amount appreciative at just over 4%, which is quite high considering that a lot of our returns are actually paid in the form of biannual dividends, putting cash back into the investors' hands that they can go invest into other asset classes and earn returns on top of returns, which we are very strong about. If you plug in all the tax benefits and obviously the exit taxes, the relevant taxes, and obviously all fees, it comes out close to an 18.62% IRR. And that really is the risk arbitrage opportunity for our investors, is that you're taking on a medium to moderate size risk to look at a stable yield of 8% within the tax incentive that is close to an 18.6% running rate return. And that is something that is a risk arbitrage, because generally to earn those type of returns, you have to make quite aggressive investments. And the real benefit around Section 12J is the tax incentive coupled with strong investment strategies, that if we can yield you 8 to 9% per annum, you can get quite close to this returns that you see on a management fee basis. All there is underlying hurdle rates, and importantly here, Meta Capital has a complete alignment with investors in terms of the performance of our portfolios. We are invested alongside these individual fund managers because we enter into fee sharing arrangements with each of them, and so if they don't achieve their specific performance fees or hurdle rates to tap into those performance fees, we ourselves as a house lose out on that section of revenue. And so our investors and Meta Capital are very much aligned to outperformance and the performance of our fund. And importantly, our user-friendly application process, it's merely one application form that allows access to these entities that you see. We conduct a FICA review, approval, and update the registry. And I'm fund closes on the 25th of February to allow for those 2 dates so that we can deploy the capital. And in 3 to 4 weeks, we'll have your Section 12J tax and share certificates, which we'll distribute back to Anil and yourselves to go forward. So to really kind of summarize, we are a unique platform portfolio offering that has been in the space now. This is our 4th portfolio. We've attracted the interest of some of South Africa's largest wealth practices as a result of our pre-investment and post-investment service. And we're proud to call Innovate a partner for this particular year. And we look forward to your questions towards the end of the seminar, as well as obviously in the next 2 weeks by the end of the tax year. Thank you.
Thanks a lot, Darren. And I do have a question for you, but what I'm going to do is keep those questions right to the end and let everyone run through their presentations. And we'll save as much time as we can for questions at the end. They're already coming in through the Q&A chat function. Up next, we've got Gaurav Nair, who's going to be presenting the Infinity Anchor Investment Opportunity. The Infinity Anchor Fund is the best performing Section 12J in its class in the 2019-2020 tax year. Infinity invests equity into asset rental businesses And Gaurav is a qualified actuary who's one of the co-founders of Geltech and the CEO of Infinity Anchor Fund. And for those who don't know, Geltech is an advisory business, an alternative investment fund administration specialist, and they offer fund formation and structuring and admin services to private equity funds, as well as unlisted real estate funds, unlisted debt funds, and other alternative asset classes. So Gaurav, over to you.
Michael, thank you very much for the intro. Before I get started, I'd like to just define some of the jargon that you see in Section 12J in the industry. And unfortunately, we also have to use this jargon, and we use it for comparison purposes. So one of the key pieces of jargon used is the concept of kind of gross capital and net capital, or risk capital. And what this is a lot of Section 12J managers, what they do is the gross capital is the total amount of capital that an investor provides the fund. The net capital is that amount minus an assumed tax deduction, so it's a smaller amount. And this has two implications. The first being that if you measure returns on net capital, the returns go up because it's a smaller amount. And if you charge fees, and you charge fees after net capital, then that leads to higher fees instead of a gross capital fee. Now, at Geltech, we like to talk about gross capital metrics, and you'll see that, but we also provide the net capital metrics, and that's more for comparison purposes. Okay, great. Just a quick introduction on Geltech. So we are an alternative fund manager. We have over 1.1 billion Rand of assets under management amongst various mandates. We have about 75% of capital currently deployed across all the portfolios. We have a low fee structure. As Michael said, we're the top performing in the Infinity Fund, the top performing fund manager in its class, and we administrate over 1.7 billion Rand of assets. Now, today I'm here to talk to you about two investment options that we're bringing to the market. The first is Infinity Performance, and Infinity Performance is the fund that we've been running for a number of years now. It was the top performing fund in the 2019-2020 year. We've been tracking a return of over 15% per annum. This is it's a net capital measure. We have had 100% of our capital invested at the end of the last tax year. We've maintained a 6-monthly dividend track record, with the last dividend being an annualized 5.2% per annum. And we have a low performance fee. This is a performance fee on gross capital, not the high performance fees of net capital. That aside, we now have another product that we bring to the market this year, Infinity Stable. And Infinity Stable was our answer to a lot of the hesitations and objections that some financial advisors had. And this is really relating to some of the poor performance that Section 12J has given, some of the question marks around exit and exposure to the underlying South African economy. So we've designed a product that mitigates around that. And then we'll talk more about that later in the presentation. First, to Infinity Performance. So in Infinity, we invest equity into asset rental businesses. By their very nature, these businesses have strong balance sheets with lots of assets on them, contractual regular cash flows, and this lends itself to a clear exit strategy. We target investing 100% of funds. This is unlike a lot of the other fund managers out there that target 80%. Now, 80% of funds is the bare minimum to be compliant. So we think targeting 80% is taking undue and unnecessary risk. And we charge our performance fees on gross capital. I want to highlight a couple of the investments we've made just to give you a sense of the type of investments we like. So the first is Secutech. We've invested in Secutech almost 2 years ago now. And Secutech is a business that rents out security technology. So I'm talking about electric fences, smart alarm systems, cameras, and it rents it out to specifically body corporates, and estates, so not individuals. And what we saw really is that Secutech's performance, both before COVID and during COVID, has been a 0% default rate. I meet the MDs of these businesses all the time, and every month I'd be asking, has anyone asked for payment terms? Has anyone asked to pause a debit? And not a single one. And it makes intuitive sense because no one wants to default on their security payments and have you come and take out their alarm system and etc. So we've been achieving a return here of almost 10%, and that's excluding the tax benefit that investors get. Another business that we invested into is Rise. We invested into Rise in June of last year, so that's during the lockdown. And what Rise does is they develop, own, and operate fiber networks and provide high-speed internet access. So, I mean, now this will start to make sense. As you can imagine, with people being at home, the increase in video conferencing, as we're doing today, more people spending time watching Netflix and so on, the demand for high-speed internet has gone through the roof. And Rise has, of course, been well-positioned to benefit from this. Furthermore, even after we came out of lockdown, we didn't see churn or people coming off and canceling their contracts. I would joke with the CEO of this business that high-speed internet is like drugs, because once you get it, you can't come off it. And in fact, he had a special where he had a discount during COVID. And then thereafter, when the prices went back up, we saw virtually 0% of people coming off. So this investment has also performed at a similar level, about 9.45%, and that's excluding the tax benefit. Now, with the onset of COVID last year, what this meant is that we went and actually had to build a pipeline, building in a new criteria. The new criteria we built in is something we call COVID resilience. And what COVID resilience is we want to see a business performing well before COVID and during COVID as we've gone in and out of lockdown. Some businesses do very well during lockdown, but after lockdown, they don't. And as an example, one of the investments that came to us and applied to us is a business that does thermometer rentals. And while this might seem like a good idea, especially back then, it seemed like the vaccine was 2 or 3 years away, that business only does well in an environment where there's COVID and where you have thermometers that are for people for access control. So we actually ended up saying no to that. It didn't pass our COVID resilience criteria. So what we did is we rebuilt the pipeline. We now have 17 companies in the pipeline. They're across numerous industries. There's a few examples here. The pipeline is somewhere between 250 to 550 million rand. The reason for the range is everyone usually asks us for a range when they apply for funding to us. And the return, excluding any tax benefit, is 10 to 25%. And most of this pipeline, 95% plus of this pipeline, is exclusive to us, to Infinity Fund. Now I want to talk you through some of the performance results. I'm going to talk you through our 2019 year, just so there's a bit of a track record to talk about. And you know, the most important thing, I guess, is track record of performance. So we had a 4.94% average dividend yield on our 2019 for our 2019 investors. That's on gross capital. For comparison purposes, the net capital number is 8.99%. So that's to compare against the other funds reporting metrics. Our return on gross capital, so that includes capital growth plus the dividends, that's been 5.78% on gross capital. This comes to a net number when you bring in the tax deduction, etc. A projected return net of 15.96%, and the 2019 class is 100% invested. Now over here, this slide, it compares Infinity's performance to that of our largest competitor. The reason we're doing this is that a lot of 12J funds don't publicly report their performance, the historical performance. So we wanted to provide the metrics so that investors can look at this and make an informed decision. As you can see, our gross dividend yield is kind of very favorable compared to our largest competitor. The rate of return is almost 16% compared to 10.8%. Now, this next metric is interesting. We've had a growth in net asset value. That's excluding the dividends paid. The net asset value has grown, whereas our largest competitor has seen their net asset value shrinking. This means the investment today is worth less than when the investor came in. We charge our fees on gross capital, as we discussed earlier. We had 100% of our capital invested by the next tax year. Our dividends are paid out of profits only. This goes back to the shrinking net asset value point. Because if your net asset value has shrunk, another way to interpret this is that dividends are being paid out of capital, at least partially. We have a low minimum investment size of 200,000 Rand, and we're proud to publicly report our performance. This is just a graphical picture of the metrics earlier, and the disparity is quite obvious. This picture here, to the left of the line is our actual performance, and to the right of our line is our projected performance, taking the historical performance into account. And what you look at against our largest competitor is that during the actual period, their performance dipped. And the projection going forward is their own projection, according to their fund fact sheet. And as you can see, they expect this dip performance to continue onwards. and it results in, over a 5-year period, up to 15% difference in return on gross capital. Now onto the Infinity Stable product. So as I said, this product was designed to address concerns around poor performance with some Section 12J funds, question marks around how will investors get their money back and get liquidity back, and exposure to the South African economy. So with this product here, what we did is we're still investing into asset rental businesses. However, in this case, we have strong counterparties. They're strong in terms of track record, a long track record in the asset rental space, and financial strength. Their balance sheets are strong. And what they do is they guarantee the investment will have a minimum income stream. And after 5 years, they guarantee to buy the asset rental book out. And this results in a guaranteed exit, which results to a predictable exit for investors and overall predictable return profile for investors. From a risk return point of view, this is of course lower risk with the risk mitigants that I described. So from a return point of view, we look at a net dividend yield of 3.69%, and this leads to a total net IRR of 10.95%. Now, both these rates are floating rates. That's important because we're in a low interest rate environment. So as we start to see interest rates climb, these rates should also climb. And as I mentioned, there's the guaranteed income stream in the underlying investments and the guaranteed exit and the ability to deploy the capital within 2 months of closing the fundraise. Now, this here just compares Infinity Stable to our largest competitor, and I'll explain why now. These ticks, they basically show all the risk mitigants that we have in place that our largest competitor doesn't have in place. But the reason for that comparison is that when you compare Infinity Stable, which is the lower risk return profile, to our largest competitor, in fact, the performance is virtually indistinguishable. However, we have all those risk mitigants in place, which our largest competitor does not have in place. And over here, what we have is just a graph comparing Infinity Stable to a cash investment. The reason for this comparison is you can see the slope is pretty similar in terms of return profile. However, because of the 12J wrapper, it provides you the ability to have your pre-tax income invested and growing, versus with a normal cash investment, it comes from your post-tax income, and hence it grows off a smaller base. And then finally, we have leverage options. So for investors who want to come in, but who potentially need to some kind of bridging until they get their tax deduction, we provide leverage. So that is where we brought up to 75% for Infinity Performance. For Infinity Stable, it's up to 45% because of the low return profile. The financing terms are slightly different, but this allows an investor to come in. They subscribe for, let's say, R1 million, but only put down, let's say, 550,000. And then when they get the tax deduction of 450,000 back from SARS, they can then pay it in. And that's my presentation. Thank you very much for listening to my presentation.
Thank you very much, Gaurav. We're going to move on quickly just to make sure that we are maintaining good time here. Our next speaker is Kip Darvel. He's going to be presenting the Enreach One investment opportunity. Now, Enreach Capitus Layson is a merger of 3 asset managers. They're certainly not new kids on the block. And the 6 executive principals manage over 400 million rands, fully deployed across 4 different funds, including a Section 12J fund. And they're really eager just to illustrate their balanced and high-yielding track record together with some of the key characteristics that set them apart from some of the regular choices that you will see out there in the market. So, Kip, with that, over to you. I hope Kip hasn't become a victim of load shedding. Oh, Kip, you're on mute. There we go. The phrase of 2020 becomes the phrase of 2021. Please unmute yourself, Kip.
Let's do it again. Try again. Is that better?
Much better.
Thank you so much. Thank you for the opportunity. It's really a privilege to have been invited. I will most probably have to sing like a canary to sing our song. Participants to make sure that the speaker is on. I've got a nice video clip that I would like to share with you as well. But first and foremost, our sincere thanks to Anil and Matt for giving us the opportunity to partake in this massively interesting and exciting presentation to your clients. I must tell you, those are two individuals that really did their DD. We came in at the back door, as far as we're concerned, but they make sure that they know what we do, how we do it, and who the people are that does the fund management. So I'm not going to spend any time on 12J per se. Enough has been said on that. Thank you for that, Neil, and most of our competitors as well. You've spent quite a lot of time on 12J specifically. I'm going to spend time a little bit and only share a couple of slides with you that really the intent is to show you what differentiates us in the market. And I really hope that you will enjoy that. It's quite an interesting thing. Most of my slides is in infographics. So I'm going to talk through that with you, and I'm going to try to share my screen now. And I hope it does. Is that shared, if I may ask?
I can see it. I can see it loud and well, bright and clear. Yeah.
Fantastic. Right. Let's start there. Right. Why is, I don't know what the problem is, but let's try again. It is extremely important, ladies and gentlemen, to take note of a fact, and our CEO, Dr. Johan Kritzinger, he's a mathematician, so his brain just consists out of files and files and files of Excel spreadsheets, whereas mine is compiled of pictures. But he taught me one thing, that everything but everything is reflected in the numbers. So in the latest SAFCA report, and that's the last theory that I'm going to share with you, there has been a massive shift towards alternate assets. So that's the March 2020 figures from SAFCA. There's been a shift towards alternate assets of close to 70% from 2018 to 2019. That's a real move. The main challenge with financial advisors and the question that investors have is, where am I going to derive returns from? The conventional doesn't do it anymore. The gold standard of cash, bonds, equities, offshore as a combination, it just doesn't do it anymore. So there's a real seek for yield, and that's really where alternate assets come in. And we are very privileged, all the partakers in this event, that we have a thing called the 12J, because that really opened up the markets for retail investors to get access to private equity as such. So my second slide, please make sure that you listen, because this really talks to what we stand for and what we are. And this is a gentleman, late Mr. Steve Jobs, and please, I would like to share this with you.
Here's the crazy ones. The misfits, the rebels, trouble, the round pegs, square holes, the ones who see things differently. They're not fond of rules. They have no respect for the status quo. You can quote them, disagree with them, glorify or vilify about the only thing you can't is ignore them, because they change things. They push the human race forward. And while some may see them as the crazy ones, we see genius, because the people who are crazy enough to think they can change the world are the ones who do. What's that?
Thank you so much. I hope that you share the vision that Mr. Steve Jobs had. So it is really how we as alternate asset managers view ourselves, and that we've got a real place in the market and that we can really add value. So the next 2 or 3 slides, I would just like to highlight what really differentiates us from most of the competitors that we have in the 12J and private equity space. First of all, and that is very, very relevant in your lives, is that we hold a category 2 asset manager license. Most of the 12Js, I think with the exception of 11 of our competitors, are all category 1. So they do the investments via a prospectus, whereas in our case, it is truly an asset managed, run by a mandate principle. We are also associate member of SAFCA, and we are proud founder members of the 12J Industry Association. So it is nice to have all the detail and numbers at hand at all times. A second important part of our business is that we actually run 4 funds, of which 1 is a 12J. So we're truly a private equity fund with a 12J license as well. And we currently manage in excess of 400 million with more than 20 QCs invested in. Currently 22 QCs, and we are 100% deployed. Every single cent of all investors' money has been invested within 60 days. Okay, that's very important. Just a matter of fact, we currently only have about 120 clients and growing at a tremendous pace, especially when we entered the retail market, taking hands and joining with distribution networks and partners like Innovate, Neil and Matt. And we're really looking forward in growing this business massively. Coming from private equity, and that's really being 2 of the comments already made, is that the real risk in private equity, alternate assets, is liquidity. But coming from private equity, we really know how to structure deals. And we've got a proud track record of, historically done 30, in excess of 30 acquisitions and more than 20 exits already. And it's all about how you do your deal structuring. So it's an important fact when looking at potential risks in the alternate space, liquidity, one of the most, from an investor's perspective, risky parts there are. In the team, we have more than 30 years experience in private equity. Our current team consists of 10 principal members. And as you've already taken note of, we are a company that came about with a merger of 3 12Js, very recent as December this year. Currently, our new name is Enrich Capitus Lysa. And we're proud to state that we are industry leaders in as far as that is concerned as well. Moving on to a very important matter, and that is really how we do business. So from an investor's perspective, you need to know that we really focus on the jockey. The jockey is the most important thing when we look at a business, when we consider investing in a QC, because you can take a mediocre company and put a great jockey in there and you will get a great business. But you can take a great business, vice versa will be the reality. So we really, really focus on the jockey and the jockey's ability to grow a business with the equity that we invest into them.
Yep, just to let you know, 2 minutes to go.
Thank you. I'll be done in 2 minutes. We only invest in running concerns, no startups, extremely important. Ray mentioned that we have a older 12J and we have substantial own skin in the game. That's really something that we pride ourselves in. In all 22 of the investments, own skin in the game. We are absolutely fee outcome based driven when it comes to fees. And we probably have one of the highest performance hurdle rates in the industry as such. On the left bottom corner, that is a current makeup of one of the portfolios that we've actually developed for the retail market. It consists of 9 underlying holdings, and generally our deal structuring mirror asset rental. So the returns and deployment and exit is exceptional on that portfolio. In the 12J growth portfolio, we have maintained a growth inclusion of the 12J in excess of 18% on the income portfolio as being dividends above 14%. And then we've got a very interesting portfolio within which Matt and them is invested. That's through our Incommodite partnership, one of the qualifying companies known as Stock V, where we hold a collateralized and securitized asset, i.e. livestock, and the yields on that has been exceptional. On the straightforward Incommodite, 15.7% growth, and on the 12J, through the 12J, 12%, and that is net. Lastly, I would like to mention all our portfolios are Sharia friendly because of the fact that as it is, 12J has very specific restrictions attached to that. So we don't invest in casinos, buying, selling of liquor, etc., etc. And all the returns that we derive from that is either dividends or profits. So that being said, that's my story, and I really appreciate. And then the last thing, I know it's been said a lot in 10 minutes. So if any of the investors, potential investors, would like more information, please through Innovate, Neil and Matt, make contact with us, and we will be glad to give you more details. So much, I really appreciate it. Thank you.
Kip Dival, thank you very much. And just like to remind all of our panelists to stick to their 10 minutes allocated. Very brave of you, Kip, to squeeze a video in there as well, but you did it. And time for our fourth fund today. Renier de Wit is going to be presenting Gaia's Section 12J investment opportunity. The fund was launched also back in 2017. In total, it's raised over 225 million over 4 rounds of funding. And the next round of funding is scheduled for finalization, obviously, this month. Renier is an actuary by training and has spent 12 years with the Sanlam Group, where he held various roles in mergers and acquisitions, product development, valuations, and financial reporting. And he spent the bulk of his time in Sanlam Emerging Markets, where he conducted M&A across the African continent and India. Renier, over to you.
Thanks very much, Michael. Just checking that you can see my screen.
I can, yep, all good.
Great, thank you very much. And thanks to Neil and Matt for the opportunity. It's lovely to be with you this evening. To all our delegates, I'm going to go quickly through our presentation and hopefully stick to within the 10 minutes. So Gaia sat back 3-4 years ago at the time when 12J really started going, and we said, what if we can put together a solution that has a positive, sustainable impact on South Africa and its people, with a strong team that has a proven track record and relevant expertise in the space, that provides stable, consistent, uncorrelated returns with inflation protection for its clients and investors. Inherently, portfolio diversification benefits at competitive fees and then at a tax break. Surely that seems like almost the perfect type of investment. Well, let's see how we go at it. So a bit of a history on Gaia. Gaia was established about 9 years ago at the advent of the renewable energy program, when we really sat back and said, we understand how these assets work, and we want to bring these assets into investor portfolios and bring our investors closer to the assets so that they can invest. Now, if you have a look at the graph there, you would see that we've concluded about 4 wind farms transactions, 5 solar farm transactions, a stake in the N3 toll road, a number of fiber optic network transactions. You'd see some macadamia nut processing and farming, table grapes, citrus on the Orange River, and then all in all, 4 billion rand that this team has invested in more than 20 transactions over the last 6 years. It's a strong team with more than 250 years of combined experience, featuring 8 engineers, 4 investment specialists, CFAs, etc., 2 actuaries, and 2 gents with PhDs. We believe that in the space where we operate, it's not only capital intensive, but it's also intellectually intensive, and that's why we need specialists in the space. Just a bit of some photos of the core team and our advisory council. You can see lots of experience there. We've got 4 engineers in the management team, even a farmer who's engineer by trade. I myself am an actuary, and then advisory council with very little hair and grey hair that really make sure we dot the I's and cross the T's. They've got experience in starting up the PSG group and having done large-scale corporate finance transactions across Africa in the infrastructure space. Just some of the transactions that we've concluded as a team over the last 6 years that I alluded to. Some wind and solar farm transactions and the N3 toll road. Many of these transactions we've concluded for pension funds, listed companies, and also life insurance companies. And we manage many of them. So with that, Gaia has proven the ability to transact, and we're known in the market to be able to conclude transactions. Quite proud of this slide. It shows our performance on our portfolio over the last 5 years. That return is CPI plus 8% after fees, which is, call it 13% on an IRR basis. The benchmark was CPI plus 5, and you'd see on a real basis, we've outperformed the major indices, being bonds, cash, equities, which didn't even return inflation, and property obviously had a torrid time over the last 3 years. But it also shows diversification benefits. It shows the benefits of investing in alternative assets, as Anil has alluded to, and that you must really diversify your portfolio as an investor. So as Michael said, we strong into agribusiness and infrastructure. So just a few thoughts on agribusiness. We know that Africa is the last frontier in agri markets. It's the last continent really where there's fertile land for us to grow healthy food for a growing population, which is now exceeding 7 billion globally. Infrastructure is a strong employer of people, with more than 70% of Africa's formal workforce being employed, and it makes up 30% of Africa's GDP. In South Africa, we know that we've got seasoned farmers, some of the best in the world, but we lack transformation. We're lacking qualified, experienced young black farmers, and we've got rising food insecurity in South Africa and globally with a higher demand. So in short, quality operations with proper integration are very attractive but difficult to locate, and Gaia has access to these. Some of the other features obviously is that when you have export product, you've got inflation protection that's implicit with the fact that you've got dollar or euro incomes and rand expenditure. You've got long-term stable returns, even though over a short period, you've got price volatility going up and down. Over a longer period of time, you've got stable returns being very uncorrelated to the market. So what have we done in Section 12J? We've we issued our first shares in February 2018. And to date, we've returned roughly 15% on our existing investments. That's on the investments themselves, excluding the tax kicker. We've declared 3 dividends during the last year, and that means our dividend yield is in the order of 7% on capital invested. 220 million rand raised with more than 200 investors, and we're approved by the large funds, and as Darren mentioned, a constituent of Meta Capital's portfolio of funds. You see a good spread of the investments we've made. Strong into macadamia farming, where a number of investments were made, processing, citrus and table grape packing. We've made some fiber optic network investments, and water management and electricity management investments.
Renier, 2 minutes to go.
This is, sorry, Michael?
I was just saying 2 minutes to go.
Good, I'll rush through it. So we spoke about deployment earlier. You'd see that how our capital that we've raised has grown. We've deployed more than 90% of the funds raised. In the last February 2020 round, we've deployed 50% of the capital, and we're closing off the last transaction now, which will see it fully deployed. Fees, we spoke about having alignment with our investors, a management fee of 2% per annum, and then a performance fee, which means that if we return capital and grow your investment by at least 10% a year, only then do we start earning, and we earn 25% of the profit above that. So I'm going to skip quickly through our investment criteria. We target stable, predictable returns above 12% per annum. It must have an ESG impact. It's part of us. It's what we do, green, clean, and we make a social impact. We've got a partnership mentality, and I think our exit is key. Our exit is baked into every single transaction. We must know what we're going to do with it after 5 years, whether it's selling it to our partners on pre-agreed terms, or it's an investment that has a runoff. Some of the opportunities we're working on, we've got a citrus farm with a group that was recently shown on Mega Boere. For those of you who watch Mega Boere, they're a well-respected citrus farming group in the Western Cape. A number of fiber optic network opportunities and a few small-scale farming solar opportunities with the farmers that we work with. The last bit that I'm going to leave you with is the fact that sustainable investment is core to our mantra. We believe that we've got to play a key role as investors in making sure that the sustainable development goals set by the United Nations are met, making the world a better place, and we stewards in that space. And I really like this quote, which was made by Edmund Burke decades ago. Nobody made a greater mistake than he who did nothing, because he could do only little. We believe that even if we do a little, altogether we'll do a lot. I left you with that list in the beginning. I believe we tick a lot of the boxes, or most of them, all of them, and you be the decision maker on that. Thanks for your time.
Thanks, Rainier. I would certainly say that 15% annualized over 3 years is not a little in the South African market, so that's some good going. Our next speaker is very well known in the industry, hardly needs an introduction, but I'm going to do it anyway. Clive Butko, he's the former Chief Operating Officer of Accenture South Africa. He's got almost 3 decades management consulting experience, and it shows sometimes at the top. During his tenure at Accenture, spent time building tech businesses in most of the tech entrepreneur ecosystems around the world. Think Silicon Valley, India, the UK, and he sits on various of the VCC's underlying companies, including chairman on 4 of the companies. And Clive also sits on the board of a large privately held ICT business. And Clive's going to be presenting on Kalon Venture Partner 2 investment opportunity. Clive, keep it to 10, please.
Thank you, Michael. Much appreciated. I just want to confirm that if my deck has been shared with Laurent, he's actually going to be moving my deck for me. So
there we go. I can see it.
Opportunity. Do you all see me?
I can see it.
Great. Laurent, can you move on, please? So as Michael said, I was the CEO of Accenture South Africa, and I've spent the last 30 years of my life really building tech businesses around the globe. So if I remember correctly, the first tech business I built when I was in Silicon Valley, one of my mentors taught me about don't tell the story about the numbers, rather let the numbers tell the story. And that's what I'm going to do tonight, is let the numbers tell the story about Kalon Venture Partners and how we've exceeded all our expectations in terms of returns to future returns to our investors. As you can see here, I'm surrounded by a very highly established board of directors, and most of them have built and sold their businesses onto corporates in South Africa and abroad. Next slide, Laurent. So I'm just going to talk. We have in our second fund, we're raising for our second fund. Our second fund has been going for 2 years now. So these are the 6 companies that we hold in our second fund. And I'm just going to talk to you about, and once again, I'll let the numbers tell the story about each of these companies and how each of them are doing. Next slide, please, Ron. I'm going to start with Ozo. Now, many of you might know of Ozo. We have quite a large stake in Ozo. Ozo is a payment solution for both buyers and merchants that allows for secure and instant payment on all e-commerce transactions or point-of-sale transactions. You might or might not know this, but 1 in 8 people in South Africa have a credit card, and 7 in 8 obviously have a bank account but don't have a credit card. So 7 out of 8 people are not able to transact on e-commerce even since lockdown because they don't have a credit card. Ozo lets them transact directly from their bank account directly to the merchant account. Now, Ozo is quite an incredible company. This company we invested 3 years ago. The company was doing 15 million rands worth of revenue. We just hit the over 100 million rand mark, so 15 million to 100 million in the space of 3 years. What's very interesting as well, we have over now about 5,000 merchants using Ozo. I'm sure many of you have used it. And the first 1 billion rands worth of payments that went through OZA took 2 years, 9 months, and 26 days. Sorry, and 16 days. 2 years, 9 months, and 16 days. Our last billion has taken us 26 days. It took 26 days in November, Black Friday, 26 days in December, and about 25 days in January. So we're at the over 1 billion rand mark. We are at the process now. We invested at about 250 million, and we're in the process now of raising capital at 6 times our initial investment value and raising at about 1.5 billion rand. And we're pretty close to concluding on that transaction. Next, Laurent. Our second company is called FinChatbot. We all know about artificial intelligence and machine learning and how AI and ML is going to part of the fourth industrial revolution and changing the world. Our revenue grew by over 102% last year. So this really is an AI chatbot powering financial services industry. You can see all those great logos on the right-hand side. We've got 25 of the top financial services companies in South Africa as our clients. And we've just raised $1.5 million from a number of European investors and started our launch of FinChatbot into the European market. We're closing our first clients in France, in the UK, in Portugal, etc. So we're looking at a significantly higher growth this year than we experienced last year. Next slide, Laurent. The next company is a property tech company called PropTech, called Flow. And this is started by 2 ex-entrepreneurs who sold their business for over 400 million a couple of years ago. We're growing aggressively. In the last few months, we've grown our client base by 70% month on month, and our revenue growth, not 30% year on year, but 30% month on month. So this continues to absolutely fly, and we're seeing some extraordinary results coming out of Flow. Next slide, Laurent. The next company is a very exciting company called Senmark, also once again started by a company whose entrepreneurs exited their last company for a few hundred million. Someone said earlier, we always invest in the jockeys. So really, Senmark is about making the internet a safer place. So it prevents phishing and spoofing attacks. So let me give you an example. If Innovate Solutions URL is innovatesolutions.co.za, if they are protected with Senmark security, no one else can send an email from their domain. If they're not protected with Senmark security, then I could send an email on their behalf and actually defraud you of your money. This actually happened to me in December, believe it or not, where I was defrauded of 14,000 Rand when I thought a legitimate transaction was coming from a bank, and I paid the money and I lost 14,000 Rand. So already we grew at close to 800 to 1,000% last year, 800 to 1,000%. We have 141 active customers. Just to give you an example of the customers, last week we met with Naspers and their Dutch holding company Process. And in the same week that we closed the deal, and they're now using Senmark to protect their domain. We're on 141 active customers and should be on 700 active customers. And this is a software as a service revenue basis business. So that 1,000% growth is every month we get paid and grow this revenue. So we are looking at this business being a substantial business by the end of this year, just based on their current customers and without even growing any future customers. And it's a 32 times growth in emails from what was in January 2020. Next slide, Laurent. Our second last company is called Mobus. Now, Mobus is a digital marketing platform. It is really unique in the South African context and quite unique in the worldly context. It really is about using smart SMSs. One of the problems you have in South Africa when someone sends you an SMS, and this is a hyper-personalized SMS, you are not able to, you have no free data or no data available. So this is something that makes your data free and allows you to access your hyper-personalized data or hyper-personalized website from your phone, from any device. We've sent over 700 million SMSs. We invested 1 year ago, and in 2019, they did 16 million rands worth of revenue. And since we invested 1 year ago, they turned that into 64 million rands revenue, from 16 million to 64, actually about a 300% growth, year-on-year growth. We're now raising a big round of capital, $4 million, to start with our going into the American market. We've got a few customers in the American market. We've closed them, and we've got 500 clients that have shown interest from our digital marketing campaign about getting us into the American market. Next slide, Durham. Our last investment we made about 4 or 5 months ago is a business called CarScan. This is an augmented reality, artificial intelligence, machine learning business, a very interesting business. So I had a bumper bash about just before COVID. And typically what happens with a bumper bash, you inform your insurance company. They tell you to go and get 3 quotes from panel beaters and then send them back to the insurance company. I went to one panel beater. They gave me 3 quotes from 3 different panel beaters. I sent them to my insurance company, and literally 3 weeks later, they started working on my car. This thing allows you to use, by using augmented reality on your phone, you take pictures in a 360-degree view. It'll pick up your VIN number. It'll pick up your car number. It'll pick up all the information, every scratch, every dent. And we've already now got, in 6 POCs, we've got a number of close clients, and we're just about to sign our final agreement with Cars 45 in Nigeria, which is already in 4 African countries and about to go into 16 African countries. And if you know, Cars 45 is owned by Naspers. So we're about to close that deal and taking our technology for both the automotive solution and the insurance solution. Next slide, Ron.
2 minutes there, Clive.
Thank you, Michael. Just about growth. So this is the growth we experienced. I'm not going to go through each of these numbers. You can get the deck. So Oslo, our growth last year was between 81% and roughly about 794% per company in revenue growth. So I won't go through the individual details, but you see all of them are in at least 100. Our average revenue growth based on our investment is over 200% for last year. Next, Laurent. Next, Laurent. We've got an exceptional deal flow. I'm not going to go through that in interest of time. So our share price in February 2019 was 1,100 Rand per share. And that has gone up to 1,502 Rand, excluding CGT. And this is on gross, going back to Europe, we only measure on gross capital, not on net capital. So our returns are on gross capital. So on gross capital returns for people that invested the 1,100 Rand in February 19, we were 33.2%, and excluding tax, 16.8%. And people that invested last year, 77.3%, and excluding tax, 36.4%. Our targeted annual returns are between 30 and 38% over the 5 to 8 year period. And I think Keert made the point earlier about we don't see ourselves as high risk anymore. This fund, you're investing into a business that's got 6 companies. We've already de-risked the fund with the growth that experience. So we see ourselves as a very moderate risk opposed to a high risk asset class. And I think you'll see what COVID has done is accelerated digital transformation in corporates in South Africa and around the globe by a minimum of 5 years. So we are seeing, and you can see that from the numbers, an unbelievable take-up of our technologies to really not only about COVID, but post-COVID, about these corporates digitizing and becoming digital businesses opposed to the current businesses that they are at the moment. Next slide, Ron. So yeah, thank you very much for your time. Michael, as I said he's going to wait for the last for the best presentation, but I think you got it a bit wrong. I think the best presentation was second last. So sorry about that, Keert, but I'll have
Clive, and I think you stole a bit of Keert's thunder on the de-risking of tech story there as well. Keert is our concluding speaker for you today. He's going to talk about KNF Ventures 2. It's the second Section 12J venture capital company raised by Knife Capital, the same mandate as Fund 1, and it's going to continue to build on some of the successes and the momentum that's already being created. Keert, also very well known, has over 20 years of investment experience in private equity, banking, and venture capital. He co-founded Knife Capital back in 2010 to scale South African high-growth businesses globally, and he's worked at some pretty big companies, Procter & Gamble, Investec Bank, and of course, Mark Shuttleworth's here, Big Dragons, and he served, or is serving, I should say, still on the board of Savca. Keert, I don't know where you find time to sit back and drink wine. Anyway, you're going to be talking about Section 12J, KNF2, and some of the opportunities that investors can look forward to in that. Over to you.
Thank you. Can everyone hear me okay?
I can hear you loud and clear.
Perfect. So yeah, Clive's not wrong. I mean, I really respect and also thanks for everything you do for the industry, Clive. I mean, really, it is a rising tide of all of us. We do refer clients to each other, and yeah, I mean, I think it's a testament to Anil and the guys putting us all through our paces, sometimes frustratingly so, hammering us on our returns and all the rest of it to make sure investing in due diligence or well due diligence funds. So thanks to everyone. It is a panel that I'm proud to be part of, And yeah, Gaia, Meta, Infinity, you know, all these offerings, I'm thinking, gee, if I now had R1 million to put somewhere, where would I put it? But hey, my whole career is in KNF, so maybe I should diversify in some of the others. So I've got some slides, so I'm not sure who's driving them.
You should
share my screen.
You should diversify.
Share your screen if you want to there, Kit.
Okay, am I driving the screen sharing, or Anil, or you guys putting out the slides?
Kit, let me share. Sorry.
Okay, cool. That'll be better. Okay, everyone. So KNF, I mean, you know, our mission mainly is to ultimately match the right investor with the right fund. So we are very passionate about entrepreneurship, very much in the vein of what Clive just presented. So you know, in the interest of not repeating, we do see this high growth technology investment, scalable asset class as fantastic, and I mean, it is risk, so we're not going to pretend that it's not risk. But what the last sort of 12 months have proven in this world is that if you have a diversified software as a service business model and you've invested in all of them, they can perform. So you know, you can go to the next slide on the knowledge networks funding, or do you guys want me to drive? Can do that. So you know, our fund's called KNF Ventures. It's you know, obviously linked to KNIFE, but it's knowledge networks funding. So we're highly passionate and really believe that any high growth investment needs knowledge and networks much more than they actually need the funding, you know, and knowledge of the craftsperson. So they need to really be good at what they do. Too much of this ecosystem is built on hype and not necessarily substance. So if those entrepreneurs in the upper quartile of what they do, they should get the funding. And we as fund managers need to really actually understand how to scale those businesses. And it's all around intellectual property protection. It's about sales, marketing, biz dev. How do we actually help them with their business models and experience that goes around that? And we do it through our networks. So the one thing that 12J has actually, I mean, it's obvious in retrospect, but that we didn't actually really appreciate and see coming, is that we've now got about 200 individuals who have made their money by being entrepreneurs or doing something interesting. They've got networks. We unashamedly tap those networks to get our companies into corporates to ultimately get them clients, and they also refer us deal flow. So and that's the thing. And the last thing, there's a lot of the people that we've actually helped exit and made money, they invested back into our fund. Okay, our next slide's good. Keeping an eye on time. So KNIFE has got a background in, as Michael alluded to, Eben and I, the co-founders, met at Mark Shuttleworth's Here Be Dragons fund. You know, I joined from Investec. We then approached Mark at some point and said, listen, can we actually spin out our own little company and manage HBD rather than just be employees? You know, it was quite a bold move, and he liked the entrepreneurial chutzpah and agreed. And suddenly we had our own company called KNIFE Capital in 2010. And yeah, the last 10 years, you know, at some point we did launch an angel investment group, Angel Hub. We launched, you know, a few investments funds, but the 12J thing started really working for us. So KNF Ventures 1, and now we're on KNF Ventures 2, and we also have a link to a UK-based family office, and that's why some of our team is sitting that side. Okay, next slide. So, you know, I think in terms of our team, it is a little bit Andrea, Eben, and myself that started the business, but we've also got Bob and Davey sitting. Bob sitting in the UK, Davey sitting in Jersey, because we are also launching have launched actually a Series B later stage fund. So in terms of our value chain investment approach, we feel that the problem with our ecosystem in tech investment is we back them to a point and then almost don't know what to do. And we run to Silicon Valley and the incubators and those type of things. So next slide. So if we then look at, can we go to the, yeah. If we look at this value chain approach, we have an accelerator called Grindstone at the earliest stage, where companies are maybe a little bit too early for us to invest in. We say, well, let us help you. Let us not reject this business. Let's put them through our paces, ultimately curate our own deal flow, but also just create some touch points and authenticity in the ecosystem. K&F Ventures fits nicely at the next phase, where we basically invest around minimum of 10 million, 15 million, average of about 20 million Rand into a business to scale them. At the moment, launching our Series B fund, and I'll post something in the chat just now about that. It was announced this morning, and further. Our whole business is based on these 4 principles of finding good investors, and what tonight is all about, finding good investments to invest in. Once you've got that, you also have to make that into a good investment. Each investment depends on the due diligence, on the negotiation. You need to get in at the right pricing, but the hard work starts in.
You've muted yourself, Kit. There we go.
I don't know how I did that, but yeah. So ultimately, to exit these businesses and realize these returns. Next slide. So some of those exits that we've had, we've been a little bit lucky. It must be added, but also hopefully, I would say by design. Some of our fantastic technology businesses in South Africa, to General Electric, Fundamo to Visa was a fantastic exit. Ikubu to Garmin, and more recently AutoTalk to Uber Eats. FlightScope, a radar technology business that we actually did have an exit offer from a European-based sports manufacturer, and the management team exited that business. So we've learned a lot through this process of going through the whole cycle. Investment is easy, but you ultimately need to bring the returns back to the investors. So our current KNF1 portfolio, so unlike Clive's portfolio, that you would be investing in the companies he presented. This is our fund. This fund is now closed. Our new fund is filling up to basically do the same. So the flavor of the stuff we invest in is the likes of Snaplify and SkillUp Education Technology, PharmaScout in the medical technology space, which does the pharmaceutical cold chain, Data Profit AI for manufacturing. Quicket had an interesting run, as you can imagine. The ticketing business during COVID really slashed their revenue, new revenue streams. Very proud of the team. Back to profitability by October, November. And it's just a fantastic story. Pura Soda, just we're at the bottling plant for their Pura Kids range coming out and all that. And in Cuba, Marketing Analytics. And we've got another company, that's the 9th company coming out. And 2 LOIs, letters of intent to invest in the new fund businesses last week. So it's kind of these technology high growth businesses we invest in. Okay, next slide. So, I'm not going to go through the case study in the interest of time, but this is basically our Data Profit business. One of the top AI teams in the world, and clients like Daimler and BMW got investment now from the IDC, as well as Norican International and ourselves, $6 million to grow them further. Next slide. Okay, you can skip these. I'm not going to explain 12J to this audience again. Okay, next, skip. And just, so to KNN Ventures 2 is just our next fund. So we're just basically continuing what we're doing. We're doing it anyway. 12J is a good tax break. It gives you a good IRR. It's almost saying to the investors, hey, we will invest your funds, and within the first year, you would get an exit of 40% or 28% or however the investment work of your portfolio. And what that does in your Excel spreadsheet calculation of IRR is fantastic. You'll see our minimum is R1 million. Because of the fact that you are linked to a intermediary like Neil and them, if there is a requirement for lesser, talk to them, and on certain parameters that could be done. So the rest of it is targeted IRRs is 30%, excluding the tax break, 40% in the hands of the investors with your tax break. We think it is about a 10-12% over the years with capital gains and that gain that you actually get. But, I think 30% is good enough. Okay, next slide. So ultimately 10 million Rand minimum investment. We pretty much look at growth expansion stage. It's not seed capital. It's companies who already have revenue and growth, and we just help them to facilitate that growth into the future. And obviously the rest is 12J related that docks our sin industry stuff. So it's very much no alcohol, gambling, tobacco, financial services directly, and that kind of stuff. Next slide. So just sort of last few slides, our investment criteria as one would imagine, 3 magical things that need to collide. Great team that can execute, large market, and a fantastic product. And we've invested in those businesses. But then we kind of look at the culture and how they're going to grow through good times and bad. And yeah, a lot of gut feel involved there as well. Last slide. In conclusion, managed by a South African growth capital investor, we have a 12J offering, which is wrapped right in the middle of an accelerator on the one hand, and on the other hand, the larger scale expansion fund when these businesses succeed. We have fantastic investors, great deal flow, some of it which as wouldn't, it's not companies that would go to other funders for capital. They basically want to exit, proven success. I mean, our IRRs are proven, it's realized, we've exited. Networks, returns, and yeah, there is a tax break. Thank you.
Thank you.
I'm sure there are many questions for everyone.
Yeah, thanks for putting the tax break right at the end, because I think there's been so much focus on the tax benefit of Section 12J that somewhere in the conversation, the idea of actually backing winning businesses and building great companies kind of got lost along the way. And this focus on performance, I think a lot of money been raised, and it'll be interesting to see how much of that dry powder that hasn't been deployed yet is going to be deployed. I think one of the
Look, it is February, it's tax season, so that it is very topical, but I think the investors must just look through at what resonates to them. I mean, there's no wrong or right 12J, you know, like ultimately, I think all of us here are just making shareholder alignment and having the right investors for Gaia or for Kalon or for KNF. That's what's important to us, you know, because this is a long journey, and we just want to make sure that that alignment works, you know, and it is about more than the tax break for sure.
Yeah. So I've got a question for Darren, and I mean, there's the old joke in private equity is how do you spot a private equity when they walk into the room, because they're the first ones looking for the exit. If you and everyone admits that exiting is difficult in 12J. I mean, it is one of the challenges. So surely if you're going to be jumbling 5 to 6 and 12Js into one fund, isn't that just making a big problem even bigger? Because now you've got to rely on 5 funds to exit. How are you approaching that?
Well, importantly, Michael, that's a very good question you raise. And I think it all comes down to exactly what investment strategies underpin each of the entities that you include in your portfolio. So as I mentioned within this particular fund, the high income fund, which has been a common theme across what we've built to date, is that they are very much asset underpin driven. And so they provide 2 things on the back of that. One, a predictable return profile, because an asset underpin can, for instance, earn contractual revenue, etc., which gives a predictability to the returns. But importantly, the pathway to liquidity, it can be realized to facilitate an exit for investors. For instance, I'll give you a good example in the renewable energy space. Those particular underpins are long-term power purchase agreements, generally 15 to 20 years, and they can then be realized 5 years from now to facilitate an exit. And there's quite a liquid market for that particular space to date. Other investment asset pins can be determined through a contractual obligation, through a put option that exists in some of the strategies. So that's where we're very mindful of. I mean, we have the luxury of choice when it comes to selecting 5 funds from a universe of 180. So they have to meet certain criteria. And one of the things you clearly recognize, as do we, is the importance of liquidity, specifically when you're building a high income fund, because the characteristics of high income are predictable returns, yes, but also an exit mechanism that is also quite predictable. And so the underpins being assets as opposed to the exciting space in tech and general private equity being your small business or intellectual property, those generally don't have a very strong liquidity profile, because you have to find a willing buyer, willing seller, where if you invest in assets that have a traditional market that can be realized very expediently, you can obviously realize that capital and return that capital back to investors. So I think I echo what Keith says, is that each investor has to be right for the specific product. If you're looking at higher returns, and I wouldn't even talk on the risk topic, higher returns and maybe a 5 to 7 year liquidity time frame, you know, then you are looking at the traditional private equity tech space. If you're looking at more stable returns with strong liquidity characteristics, then some of the other funds come into play. So I hope that kind of gives a little bit of our thought process as to why we select these funds, what common characteristics they have, and the liquidity especially is a very big determiner for us as to who we include.
Yeah, and quite clearly, it's something that you've got to manage through particular cycles. And so one has to also have a look at what prevailing conditions are at time of exit. I want to move on to a question for Gaurav now, and it's from Shane Perrier, who's put a couple of good questions into the chat box so far. And Shane, I'm not going to answer your question on what I do with the R1 million right now. I think that would be prejudicial to everyone who's put a very good offering on the table. But share your number with me and I'll let you know offline. Gaurav, Infinity is, and this is addressed to you directly from Shane, is your nearest competitor in the same field or across the 12J industry? And then a second part of that, also you charge your performance fees on gross capital, yet you show returns on net capital. Why do you do it this way?
Perfect. I think a very fair question. So our largest competitor is, we're comparing ourselves against someone that is doing exactly the same thing, investing into equity into asset rental businesses. And so then moving on to specifically the question around the returns. So just to be clear, when the performance fee is based on gross capital, that results in a lower performance fee because the fund needs to return at least the capital that the investor gave before any performance fees accrue. Whereas charging a performance fee on net capital, that means that they return a smaller amount before they start charging performance fees. And the difference can be quite large. So now when you say, well, why do you charge fees on gross capital? That's better for investors. We believe that at the very least, you need to return the capital the investor gave you. But now on to measuring the returns. I'm glad to see you in the panel here. The guys are very cognizant of this kind of misinformation and the funds over here don't engage in it. But a lot of funds out there, they talk about net returns. So, we try to include both metrics. We talk about the gross returns and what our return on gross capital is, what our dividend on gross capital is, as well as the net metrics, because just to be comparable to the other funds out there. And I think that's, testament to Anil's selection choice in terms of the panel here.
Speaking of that, Anil, would you like to tell us what you do with the R1 million? Come on, put your put your money where your mouth is.
Yeah. So I think the first thing is obviously the client's appetite for risk. They are getting the tax break, and you find generally a lot of investors we find gravitate towards the moderate risk. However, if I had to look at it, Gaia, in my opinion, is a moderate high risk, and Reach is also a moderate high, it's a diversified portfolio. And then, I think Keith and Clive do have an argument that technology is not as high risk as we thought. It does perform in this type of environment. In COVID, it performed, as you can see from Clive's impressive numbers there. Keith also, in data profit was 5 times its value. It grew from 80 million to 480 million on the next raise. So to answer you, Shane, definitely there's a space for a diversified portfolio. And if somebody is kind of stuck in the mud in moderate risk and they haven't really been getting the returns, I think there's a space to take a bit more risk because you are getting that 45% tax back. So you're only effectively risking 55% of your capital if you're a marginal taxpayer at 45%. Yeah, so I think definitely that. And the moderate risk also got a role to play for people that are looking for dividends, where you're looking for 5 to 8% dividends. It's definitely a lower risk profile, and you're getting the 8%, which makes up a return called A, and you're getting the 8%, 8.4% from the 45% tax break, which makes it 16% of tax return. So yeah, all of them have a place. So yeah, moderate risk, moderate high. We love all 6 projects. And generally, if somebody says, I have 2.5 million rand, we normally put people into either 4 or up to 6, depending on how we want to split the portfolio. Yeah.
On that point, and we know the caps came in. Treasury's had this ongoing conversation with the industry, and there are certain fund managers who raise a lot of capital, haven't money account somewhere, and there's a big question mark over the future with the sunset clause, of June this year. Would anyone on the panel like to hazard a guess or to speculate as to the future of Section 12J? Is the case strong enough, and is the cost benefit for Treasury demonstrable enough for them to say, right, we'll continue to give this very generous incentive. To Darren's point, it's only 30% in the UK, and also considering the backdrop of our dire fiscal situation.
Do you mind if I try to answer that?
I don't know if anyone.
I think the real question for the potential investors, for all of us, the fund managers here, it's not something to worry about. That's the most important question. I just want that first, because irrespective of whether the sunset clause is extended or it's not extended, now is the opportunity, now in February and then until June, to make an investment into 12J that you will still receive your tax deduction. The 12J company, all the funds that spoke here tonight, will continue irrespective of whether the sunset clause is extended or it is not extended. So nothing to worry about whether it's extended or not. My opinion on whether it's going to be extended, I unfortunately have heard some internal rumors that it might not be extended because of the fiscus, and the government needs to put every cent into the fiscus. But at the same time, I do know that the Section 12J lobby group is lobbying the government very hard to get that extension. So, you know, it's I don't know if someone wakes up on the wrong side of the bed one morning to make this decision. But unfortunately, you made the point earlier. I think there's a couple of rotten tomatoes in the barrel that have actually affected the whole bunch. And I think it's unfortunately Section 12 has been given quite a bad rap in National Treasury, and potentially I think that runs the risk of this thing not being extended.
Oh, well, to my introductory comments, it would be sad because the cost benefit is clearly skewed if you look at this panel in favor of keeping it going, because of the amazing examples you've got of companies, jockeys growing through a pandemic, pivoting their business models, and in the most difficult of environments, just continuing to grow and create employment. And it's something we need in the country desperately at the moment. I just want to move on to a question around regulation. And again, from Shane Perrier, now that it's obviously a much more well-known and well-understood asset class, is there a benchmarking tool on parameters to measure the performance of different Section 12J companies, such as IRR and risk level and costs, on the various participants in the industry? How does one, if you're coming in blind, how do you compare apples with apples, and ensuring that you're not getting any of those rotten tomatoes?
Maybe I'll just, from a just overseeing point of view, as in when we do our investment process, we try to standardize, as Shane's point is very, very depth, is that we want to try to standardize the performance metrics. And I think specifically when they do due diligence with ourselves, the performance and the IRRs are very much standardized to try have that gross investment return as the main proposition within the investment thesis. Obviously, the tax benefit can be shown because not many of us will be on the call if we're just having a 5 to 8% dividend yield to showcase to investors. But importantly, I think the standardization will have to come from the industry itself. I think the association body, should it get extended, might play more of a role to try standardize things. But I think naturally over the last 3 years, at least in our case, we've seen more standardization taking place of returns and how they are showcased to investors. You know, one thing I think people need to remember is that a Section 12J entity is quite an onerous entity to run. It's an FSCA approved financial services provider, which means it needs to be every year. We need to report to SARS biannually. So from an investor's point of view, they can feel comfort that they are investing into most predominantly public unlisted companies with certain reporting requirements, AGMs that have to be had. So that should give a few investors a lot of comfort around this, the onerous structure that's involved in just operating the 12J on a day-to-day basis.
Right. We do, once again, certainly hope that it is extended and that there is some mechanism to deal with those rotten tomatoes, as Clive mentioned, in order for the industry to perhaps better self-regulate. I don't want to get too stuck in that at the moment, though. There's another question, Rainier, to you that was posted earlier during your presentation, where, and I forgot who posted it. I just sort of copied and pasted the question without their name, so apologies for that. But they wanted to know more about your exit strategy at the end of the 5-year investment period, who the shares sold to, and is the exit strategy 100% successful?
Yeah, thanks for the question, Michael. So, I mean, our strategy is very much focused firstly on partnering with solid, stable, farming groups as an example that have been there for generations and that want to continue expanding. So, as one example, you've got a table grape farmer who's expanded, added another 100 hectares, but now the pack house is too small. So either he can go ahead and fill up the pack house and expand that, or he can partner with us, utilize his capital for further expansion, and we help him in his pack house to build that out. In all of our transactions, we then partner with them. They put their own skin in the game, and at the end of the day, they want to buy back this business from us. They want to continue doing what they've done before. Nothing stops us from pursuing the road further and doing further transactions with them. And in certain cases, we pre-agree a transaction, like a guarantee type exit. And in other cases, we've got a follow-up fund that will purchase that opportunity at a specific rate of return. In terms of, so we haven't exited anything out of our 12J fund. It's only been going for 3 years. But we've had a number of exits on some of the other funds that we manage, the more private equity and infrastructure funds, where we've had good returns for our customers.
Super. Right. Just as you were talking there, I was thinking about the state of the country and the fiscus, and I think taxpayers are pretty fed up, and I know lots of people talking about potential tax revolts or what we do about it. Well, if you want a perfectly legal way to send a message that the geese are fed up, I think if every payer of personal income tax invests in a Section 12J, the fiscus would take a pretty big haircut, and that would be a nice legitimate way to demonstrate that you're pretty tired with the way taxes are being spent. But just tongue in cheek, really. Just as we wrap up, I see there's only a couple of minutes left. So I'm going to hand over to Matthew Lee, who's a partner at Innovate, just to conclude things and to round everything off. So you won't hear from me again. Thanks, everyone. Thank you very much. And thanks to our panelists. Fascinating insights into your various portfolio companies and your investment strategies and the success that you've had so far. Well done in this brutally tough environment. It's some going, and I'm sure you guys are going to be very busy in the weeks ahead, tax season and all. And I've certainly learned a hell of a lot. Thank you to all our participants for logging on. And with that, I'm going to hand over to Matthew Lee. Cheers.
Thanks a lot, Michael. Really appreciate it. And guys, I just wanted to say thanks to all the participants that has attended. We really appreciate your time. We know we ran a little bit over time, but we do appreciate that you guys could take the time to be here today with us. And yeah, a big thanks goes out to all of our panelists and our 12J companies that we will deal with. We really appreciate you guys, and thanks for sharing your time with us today. Just to end off, to not waste any more time, I'd like just to let you guys know, should you guys have any inquiries on any more detailed information on any of the 12Js, you're more than welcome to contact us. Our contact details are on the screen that Anil put up there. So guys, thanks a lot, and we look forward to hearing from you. And yeah, a special thanks goes out to Jaltec as well for helping us put this event together. Jonty, we appreciate you. And thanks a lot to everyone who attended. Look forward to hearing from everyone. Have a great evening.
Thanks all.
Thank you.
Cheers. Bye.
All right. Thanks. Thanks, Matt.
Cheers, guys.
Everybody, appreciate all the panelists and all the attendees. Good job.